Hello, trading friends, and welcome to Forex Focus, brought to you by IG, taking a look at the upcoming inflation data out of the U.S. and how important it's going to be to the entirety of the U.S. economy, but specifically U.S. dollar, gold prices, and U.S. interest rates, of course, baked into both those pieces. Let's start with the USD part of this story, as there was a lot of U.S. dollar strength to start 2024 and a lot of strength off of the last inflation data point that came out, and no coincidence that you're seeing the low for euro dollar, or what has been the year-to-date high for USD in this pair in particular, and that was correlated with the last CPI inflation data print that came in a little bit higher than expected, and we'll get to that in just a second. But since then, the dollar has dipped and it's cooled off a little bit, not to a huge extent. As you can see in the last couple of weeks here, it's only been a matter of euro dollar bouncing back from around 107 to above 108. So not the biggest move in the world, but a dollar dip for sure. And in that same time, we've seen gold prices regain some of their strength. This market, in multiple instances now since the end of 2023, has been able to bounce off of $2,000 here, and has gotten back to nearly 2050. And you'll remember that these historic highs that we've seen in recent years for gold, right around 2100. And so splitting the difference between that $2,000 level and those historic highs around 2100 going into this next inflation data point is kind of the inverse of that US dollar move, right? You would expect that US dollar weakness that we've been seeing the last couple of weeks to correlate with some gold strength. They don't have to be one for one, but that's been the recent correlation. And we'll get to the interest rate piece that kind of connects those two markets to end today's segment. But I do want to bring in the inflation data here to make sense of the recent movement, but also what to look forward to with PCE inflation. And as a side note, PCE and CPI inflation, different calculations for U.S. inflation, both very heavily looked at. Traditionally, the idea has always been that CPI is a more relevant number a lot of times for traders and consumers in general, whereas PCE is a number that's always associated with the Fed. The Fed really likes to look at this number. Now, all of that being said, any inflation data in the U.S. is going to be very important, especially given the recent trajectory we've had in inflation. We've been coming off of the highs that we had in inflation in the U.S. More than a year ago, and very consistently with PCE in particular. Here, looking at core PCE, it's been several months in a row moving to the downside, looking to get to that 2% target that central banks like the Fed usually look for before maybe lowering interest rates. And we'll get to interest rates, like I say, in just a second. But right now, hanging in around 3%. The expectation is that PCE inflation will move lower again this month and will move to 2.8%. But keep in mind that that number is going to be very, very important. Even if it's 2.9 or 3%, will definitely move markets, because you look at the last CPI data print, and this might not look like much. Oh, it looks pretty similar to PCE, obviously. It's U.S. inflation, just a different color of it. But what the big piece was here was that there was no movement from 3.9% the month prior to where it was expected at 3.7%. And so that flat movement in inflation was actually higher than expected. And that would be a similar case with PCE. If it comes in at the same as last month, or 0.1% or 0.2%, any amount higher than that, that would be higher than expectations, and might, similar to the last CPI data print, send that US dollar higher. And now let's bring in interest rates, because why would US dollar move higher if inflation in the US is moving higher? Well, remember the middleman, so to speak, interest rates in here. And the US hiked interest rates to above 5% around the peak of inflation about a year ago. And we've stayed around 5%, higher than 5%, haven't cut yet. But the expectation in 2024 was, well, inflation will move down to that 2% target where the Fed wants it, and then they'll normalize rates lower to maybe 3 or 4%. And with the higher than expected inflation recently, those expectations for rate cuts have moved out in time. And now we're looking the greatest likelihood of a rate cut coming now in June. And even those odds are getting close to 50-50. Now there's up to a 36% chance of no change in interest rates by June. And you'll remember that in prior months, there was a greater likelihood than not of a cut in March and then in May, and now those have pushed out to June, and now it's getting close to 50-50. And so if this inflation data comes in higher than expected, you might see interest rate cuts get priced out of the market. Interest rates essentially move higher than expected, and that usually, theoretically, would coincide with a U.S. dollar appreciation given the strength in the interest rate markets and potential greater demand for that dollar in pairs like euro dollar or dollar yen. And so there's that connective tissue. Oh, and last bit, remember that gold is a non-interest bearing asset. And so if you see higher than expected interest rates in the U.S., higher than expected yields, higher prices for U.S. dollar, greater demand for that U.S. dollar, there might be less demand for that gold market in there since it doesn't bear any interest. And there's all the pieces around this upcoming U.S. inflation bit. We'll see what the number comes in at and where dollars, interest rates, and gold move after the fact.